Are you one of the millions of investors that are secretly terrified that your entire portfolio is a bubble waiting to pop? You check the price every day, but you have no idea if those big names you own are overvalued, or have you accidentally found a hidden bargain? Stop guessing, stop worrying. There's one simple number, one financial fingerprint that tells you exactly how much future risk you are carrying. I'm talking about the PE ratio, but not just for a single stock. Today I'm going to show you the advanced technique to calculate your portfolio PE ratio and instantly tell you whether you're a smart investor or paying for hype. Let's decode the one metric that separates the serious investors from the gamblers. So, what's a PE ratio? PE stands for price to earnings. It's the ultimate way to answer one question. How many dollars are you willing to pay right now for every single dollar of a company's annual profit? If there is a PE ratio of 10, then you're paying $10 for $1 of profit. Sounds good, right? But here's where most people go wrong. A low PE could mean a company is cheap, but it could also mean the company is about to die. A high PE value could mean explosive future growth, but it could mean it's grossly overhyped. So you need context, and that context comes from your entire portfolio. Alright, this is the advanced knowledge. You cannot just average out your PE ratios. That's a massive mistake. Instead, you need a weighted average portfolio PE. So for that, we need to calculate your total earnings of all your companies combined. Why? Because the stock you own $50,000 of should have more influence than the stock you only own $5,000 of. Here's the simple hack. For every stock you own, take the total value and divide it by its own PE ratio. That gives you its total earnings contribution. So stock A, total value of $5,000, divide it by its PE ratio of 10 and the earnings contribution is $500. Now stock B, $15,000 total value, divide that by its PE ratio of 30 and you come out with earnings contribution of $500. So the total stock value is $20,000 and the earnings contribution is $1,000. Now divide your total portfolio value of $20,000 by your total earnings of $1,000 and that gives you a portfolio PE ratio of 20. This is your number, now memorize it. So you've done the maths. You have a portfolio PE ratio of 20. Is that good or bad? Let's put it into perspective for you. Right now, the overall US market, represented by the S&P 500, has a trailing PE that often hovers around 27 to 30. The historical average of this market is typically around 17 to 20. Your PE of 20 tells you two critical things. Compared to the current market, you are undervalued. You are paying less for every dollar of profit than the average investor in the market. This means you're leaning towards value investing. Compared to history, you're perfectly balanced. You're right in that long-term historical Goldilocks zone. This number isn't a grade, it's a GPS for your strategy. What if your number was 10 or 40? This is the nuance that will save you money. I see people making this mistake every single day. There's no assumed good PE. It depends entirely on the industry and growth. A PE of 12, like for a utility company, is perfectly healthy. They don't grow much, so they shouldn't be so expensive. A PE of 45, like for a tech company, is also common. Investors are paying a massive premium because they expect 50% revenue growth for the next 5 years. But a PE of 45 for a utility company, that's a bubble waiting to pop. The risk is a low PE can be a value trap, a company that is cheap because it's dying, and a high PE could be a hype, a company that needs a massive unsustainable growth just to justify its current price. If you're serious about this, we have to talk about a metric that fixes the PE problem, and it's called the PEG ratio, price to earnings to growth. The PE ratio completely ignores future growth. The PEG ratio doesn't. This is what makes a PE of 30 suddenly look cheap. If a company with a PE of 30 is expected to grow earnings by 30% a year and the PEG ratio is 1. The legendary investor Peter Lynch said a PEG of 1 means the stock is fairly valued. So a PEG below 1, like 0.5, is screaming bargain. A PEG above 1, like 2, is overvalued. This allows you to finally compare that boring bank with a PE of 12 to an explosive tech stock with a PE of 40. So here's your action plan. Right now, open your portfolio tracker and do these 3 things. Calculate your portfolio PE. Use the weighted average hack to find your number. Benchmark to the market. Compare your number to the S&P 500 PE, currently around 28. If you're lower, then you're playing defensive. If you're higher, you're playing offensive. Check the PEG. For any stock in your portfolio with a PE over 20, check its PEG ratio. Is it below 1? If so, you've found smart growth. If it's 2 or higher, you might be sitting on hype. This isn't just theory, it's the fundamental of wealth creation. Understanding this ratio can stop you taking financial advice and start becoming your own analyst. If you found this video helpful, make sure you like and subscribe so you don't miss out on the next beginner investing series video. And here's the thing, I've noticed that 68% of those that are watched regularly are not subscribed to this channel. The best way you can support me for free is to like, subscribe and share with like-minded people. My whole mission is to show that an average person just like yourself can build a solid financial future through consistent dividend investing. I've also got my monthly portfolio updates here right on this channel. In under 10 minutes I'll show you exactly how my portfolio performs and what dividends I've been paid. If you want to connect even more, join me over on the Dividend Dad Facebook page. It's where I share updates, behind the scene thoughts and I have conversations with other investors just like you. Drop a comment below. What's your portfolio PE right now? Let's start a conversation about real value. See you in the next one.